All right. I'm here with Andrew Giancola, a fellow entrepreneur. How's it going, Andrew?
I'm doing great. Thank you so much for having me here.
Yeah. Yeah, we actually just figured out that we were pretty close geographically while we were while we were getting ready to record, which is pretty cool to figure that out. Meeting somebody virtually when we're kind of close physically is
Exactly.
crazy.
It's crazy. We're like 30 minutes away, which would have been awesome.
Yeah, yeah. Well, I'm excited to have you on. You've had multiple successful business ventures, and before we unpack that and the personal finance side of things, let's talk about you and your background. How did you get started in business?
So I got started by actually, working in the corporate world. And when I started to work in the corporate world, I realized very quickly, after my first couple of years, that I didn't want to do this forever. I wanted to achieve financial freedom. I wanted to pursue financial freedom. And the way that I saw doing that was, going out and starting a business. And so I had all these different business ideas that I wanted to start when I was in the corporate world. I tried everything from reselling things on Amazon, starting an eBay store. I even had a Christmas tree stand, one of those side of the road real Christmas trees that you sell, a Christmas tree stand every single year. So I tried literally everything to try to find a business, and then eventually was able to exit the corporate world with a real estate business. And that's kind of where I got started. And real estate was a great starting point for me because you learn a lot about systems and procedures and operations. And so it helped me kind of get the ball rolling into everything else that I do now.
Nice, very nice. A Christmas tree stand is a wild one. That was it. Just one season that you tried it, or how did that work?
It was one season that I tried it. We made about $7,000 in a month. And honestly, at that point in time, it was just my wife and I, which was a lot of money to us. And the reason why we started it was she had an aunt who had two Christmas tree stands, one in North Carolina and one down in Florida. And she would make about $100,000 per year just with those two Christmas tree stands. And she only had to work in December. And I was like, man, I want to try that too. And so she had the connection with the farm. We called the farm. They allowed us to have some trees on credit, about $7,000 worth of trees on credit. And so we set up a tent, we set up the stand and everything else. And all in, we spent about, $7,000 to $10,000 on that Christmas tree stand. Ended up, making about 17 total in the end. So we ended up, netting about $7,000. And honestly, if we would have kept doing that over time and found a better location from where we were, I think we actually could have made that very profitable.
Yeah. Yeah. I remember reading an article about how some of these seasonal businesses like the Halloween stores and the fireworks stands and stuff like that, just their model is wild. How it just, they could pull in $500,000 depending on the location in just a matter of 2 months or so. And then they're done for the year. And it's an incredible just example of having good systems in place,
It truly is. And they really are actually good businesses. Even like if you think about, like as of recent, we're recording this, right after, Easter holiday time, there's flowers, there's Mother's Day coming up. There's so many different types of those businesses that you could start that honestly aren't going to go anywhere. That's one of those things like AI is not going to take those things away. There's a lot of cool stuff that you can do with a lot of these businesses because they're nostalgic and a lot of people really enjoy that kind of stuff.
For sure. For sure. So let's talk about kind of your trajectory here. Like you got into the real estate business that you really kind of saw some success in. What was the kind of aha moment when it came around, like mistakes that you were going to make in terms of like exiting and getting around exits? Because I think a lot of people learn valuable mistakes as they're getting ready for an exit, whether it was the real estate business or the next venture.
I think a lot of the things that I learned over time were twofold. So some of my first early businesses, especially the real estate one, some of the ones that I've done later on down the line, is a few of them had partners. And structuring that partnership up front is very, very important. Making sure you know who does what, who is supposed to be kind of handling certain things, but also making sure that partnership agreement is airtight. Because if you have some of these handshake deals like I did early on, that is going to be something that is not the best thing overall. Maybe it's your friend, maybe it's someone you've known for a while, or someone you just feel as though you can trust. You need to make sure those are ironclad first. The second thing is if you're going to go out into a business venture and you're going to get started, halfway through or 3/4 of the way through, you need to make sure that you have your finances in order. And there's a number of things that you can do when it comes to your finances to make sure you structure it in the proper way. But you want to make sure that your personal finances are in order so that you can make the best possible decision and from a position of strength instead of a position of weakness. If you have your finances right and you have everything in the proper order, you can make a lot of really valuable decisions and better decisions for you personally long-term if you have that structure in place. And so those are just some of the things that we learned along the way, especially after my first business, and some of the things that we structured right. Also is just making sure that if you do decide you want to exit a business, or your plan overall is to exit a business long term, make sure you think like someone who is going to exit this. Make sure you have the systems in place, you have the SOP structured properly so that you can hand that over to a potential buyer. Make sure you have your financials in order, and every single year you have a CPA or someone in your corner who can help you through this process to make sure everything is clean. Because if you think of this in a way as if you were going to come in and buy this business, what would I want this to look like? That is a powerful position to start from.
Mm-hmm. Yeah, well said. Because I remember there was a while back, people were talking about secondaries and rounds after they raise money and stuff like that, and taking some money off the table. I remember hearing was a controversial piece, but it's very similar in this sense, in that people would feel like a financial stability and they could make clearer calls when it came to running like a venture-backed startup, for example, where they didn't feel like they were just on edge all the time. And I think that similarly, when you're exiting, it makes total sense to have like some really sound foundation underneath yourself so that you can go through it, and maybe it doesn't go as planned like most of them do, but ultimately you kind of have like a good stance personally, which is a great insight here.
Exactly. And a great example of this is like someone, for example, I know a lot of people with startups, especially when you're raising capital, you're raising money over time. A lot of folks don't pay themselves early on. So maybe they weren't in a good financial position when they started. Maybe, you started this as a college student and you started to build up this business. And then all of a sudden you get to this point in time where you are ready to exit or ready to take some, equity off the table. And when you do that, a lot of times, if you are in a good financial position, you can make a much stronger choice than would be if you are someone who is just broke and never really made much money and you don't have much money on hand. And so you can make a lot more positive decisions if you actually structure it the right way.
Mm-hmm. So it's kind of a good segue into preparing the business itself. And then we'll talk about like personal finances, like actual tactics. I'd love to get your take on this. So let's start with the business first. What can people do to kind of maximize the valuation of a business, and how can they prepare a business? And then we'll go to what they can do personally.
Absolutely. So one of the first things overall is to make sure that you are every single month kind of monitoring your financials. And that's the first thing you want to do, because what you want to figure out here is, top line revenue is one thing. But what a lot of folks are really interested in, at least in the world that I have been in the past, is they are interested in the actual profitability of that business. So a lot of people will brag about their top line revenue, but how profitable is this business? This is a really, really important thing that you want to be looking at. Increasing that profitability should be your number one goal overall. That's really, when I am looking or evaluating a business, that's really all I care about. And then looking at the multiple based on that profitability. And so when we dive deeper into some of those financials, again, having a CPA or someone who understands how to put these reports together so that you can look at them and then make sound decisions. So I make all my decisions based on a lot of these different financial reports, from the P&L to the balance sheet. And I go through there and see, hey, okay, which departments are the most profitable? Which areas do we need to bring profitability up and focus our time and energy and attention on? And how can we go about doing that? So that is number one. Then once we bring in all of these new ideas, then we want to create SOPs or operating procedures around them. Why? Because we want this to be repeatable across the company. But in addition, we also want to make sure that those procedures can be shown to a potential buyer when they come into play. If they're evaluating your business, you want to show them exactly how this can be done. And so we created, SOP systems for a lot of team members that can help put this together. And then thirdly, you want to make sure that you actually have strong financials. That's a big deal. And so when we're making these decisions, we want to make sure that we are increasing those profitabilities and top line revenue both, so that we can get to the point in time where we have those strong financials. So that's some of the starting points that I have and the way that we kind of think about this. And so a lot of times you really should be beginning with the end in mind when you structure this, and starting out with all of this stuff in play. And if you start, even if you're just getting started or you're in the middle of operations right now, doing this now will absolutely change your life, because A, it keeps you organized, and B, it actually reduces your stress and anxiety around the business because you have these repeatable systems.
Mm-hmm. And what would you say is like the timeline? How long should somebody be doing this in advance before an actual go-to-market for finding a buyer would look like?
For me specifically, is as early as you possibly can. So if you're someone out there who says, hey, I want to sell this business within the next year, then you absolutely should be starting this right now. If you want to sell it in the next 6 months, you should be starting this right now, because it does take some time to create these procedures. It is not something that happens really quick or overnight. You want to make sure you have these procedures in place. You want to make sure the staff understands how these procedures work. If you are a solopreneur or you don't have a staff in place, you just want to make sure that all of this is running, smoothly and the operations are moving forward. Otherwise, if someone comes into play and they say, hey, we just put these into place, 2 or 3 weeks ago, that's not going to be something that's reassuring for a buyer. So you want to make sure that all this stuff is in place as early as you possibly can. But for the most part, at least a year out is where I usually look at this.
Yeah, for sure. And from all the conversations I've had, I would say a year is moving pretty quick. A lot of times it's 2 years, 3 years that people really spend time optimizing. Because like you said, it used to be in early 2020s, it was about growth at all costs. And that changed pretty quickly after COVID around just be profitable. And so people all tried to, spend a couple of years to really increase that profit so that they get ready for a sale. And it is so interesting how different people take more time to do things and implement different SOPs and stuff like that. But well said. Now let's shift to the personal side. We kind of focus on the business there initially, like how we can drive up that valuation, increase profit, get things prepared with your books and everything. What can a listener do right now personally to kind of get that strong foundation under themselves before an exit?
The number one thing that you want to do when you get started is you want to make sure that you have cash on hand. And so this starts with what we call an emergency fund. Now, we typically do this in a specific order that we call the 1-3-6 method. So it's really getting 1 month of expenses saved up first. Then once you have 1 month of expenses, we want to make sure we remove any high interest debt. So if you have credit card debt, maybe you have lingering personal loans, maybe you have some of this additional debt, we want to get rid of that as fast as we possibly can. Now, this high interest is classified as anything above a 6% interest rate outside of your mortgage. So any of that debt, maybe you have, it's usually just consumer debt. It's stuff that you have on hand. That needs to get eliminated. Then we want to move to 3 months of cash on hand and eventually try to get to 6 months of cash on hand at a minimum for a business owner specifically. Because if you are looking at this and you're saying to yourself, if I have 6 months of cash on hand, this gives me 6 months of breathing room to make a stronger decision going forward. Now, for a lot of business owners, if you can start to slowly tick that up over the course of time to 12 months of cash, if you have a longer runway where you can think about this, that is going to help you make really powerful decisions. Because then if you decide to sell your business, you don't have to go out there and make a choice that is wrong for you long term, or maybe you're taking less money just because you want to get paid because you need some cash to be able to take care of some other things. Instead, you are negotiating from a position of strength. And a lot of times when it comes to negotiations like this, the person who cares less or it matters least to them, that is going to be the person that wins in a lot of these different negotiations. And so for you specifically, if you have this cash on hand, that gives you enough runway to think about this. Or if there's an issue in the business or something along the way and you can't pay yourself for a couple of months, this gives you that runway to allow you to take care of anything for uncertainty. So at the minimum, we want people to start off with having this cash on hand and making sure you get any of that high interest debt paid off so that you are starting from a position of strength. The last thing you want to be doing is making debt payments, high interest debt payments, when you are also trying to negotiate deals, because that is one of those areas that is just going to take you backwards instead of forwards when it comes to your finances.
Mm-hmm. So a lot of it being kind of the Dave Ramsey concept of having that emergency fund set up, right? Where you're feeling like you have a bit of a personal runway, almost like a mindset concept where you're just trying to clear your head, know that everything's going to be okay with 6 months. Are you saying before getting ready for an exit, or is this sort of in parallel? How are you viewing those two together?
In parallel. So a lot of times, this is not an easy thing to get 6 months of your expenses kind of saved up, right off the bat. So what you want to do is do this over time. So as you're starting to prepare for an exit, or as you're just starting to build up wealth in general, you want to make sure that you're doing this in sequence. So the first milestone is that 1 month. Then it's paying off that debt. The second milestone is then 3 months. And then finally, it's getting to 6 months over that time frame. So this could take you a couple of years to do. And for a lot of people, it does. But it's one of those areas that just helps you start from a position of strength. Also, it helps protect a lot of folks out there if, let's say, you are building a business, but you also have a spouse who's working. Well, if your spouse who's working loses their job or something else happens, then this is going to help you recover and make up from some of their income if that does happen. So the biggest thing the emergency fund is there for is taking care of life surprises. If you have a car that breaks down, if you have, something that happens to your house, it doesn't derail your financial life where you have to go backwards or into debt. Number two, it allows you to take advantage of opportunities. And that's the number one thing we as business owners want to make sure that we are able to do is be in a position of strength to take care of opportunities. And then number three, it allows us, if anything were to happen in the business or any other income was cut off, we have this runway so that we can make solid financial decisions.
Mm-hmm. And one of my favorite mistakes that I've heard, and I think I've made myself and many people make, is going through an exit. There's a lump sum, let's say, but your lifestyle is at a certain level, and that math often doesn't add up to the point where you have a lump sum that doesn't really calculate over the course of 3 years of your current lifestyle. So what type of kind of tactics have you found around like income replacement, where let's say somebody sells their business, they don't have, the runway set up properly and their lifestyle maintains the same way as if they were having that income from the company and it's gone now. How do you view the income replacement?
So the number one thing that you need to do when it comes to your dollars that come in, either from an exit or whatever else, is think through, okay, when I get this lump sum, how much can I actually safely withdraw from this lump sum in order to make it last me a long term? So on average, what a lot of people will do is they utilize something called the 4% rule. If anybody's ever heard of that, that is a rule that was studied back in the day with this study called the Trinity study. Bill Bengen is a guy who actually came up with this rule long term in terms of how much you can withdraw from your portfolio in retirement. And so a lot of times, if you get a lump sum that comes in and you decide to invest those dollars, whether it's in index funds and ETFs and bonds, things like that, that is something where you can consider. And when you do that, you can safely withdraw 4% every single year. So every every $1 million that you have on hand, that means you can withdraw $40,000 per million and safely withdraw that money where it preserves you for 30 years. But you can run this calculation a number of different ways. So you can say, okay, if I invest these dollars and let's say it's $1 million, if I invest these dollars and I need this money to last me for 5 or 10 years, we can do a calculation that decides how much can I withdraw every single year for it to last me during the time frame that I need it to last me for. And so the 4% rule is the safe way to withdraw this, but you can look at a bunch of different other withdrawal rates and have the ability to be able to predict how long this portfolio is actually going to last you. Now, what is the risk with this? What is the biggest risks overall? Well, there's something called the sequence of returns risk. And what that means is if you do invest this money and the market begins to go down or the market begins to shift, that is where we need to make sure that we understand that sometimes you're going to have to withdraw a little bit less if there's a pullback. Like at the beginning of this year, we saw a pullback because of oil prices. We saw a pullback because of a number of other different factors as well. And so when that happens, you want to pull back just a little bit less, which is where your cash comes in that we were talking about early as well, is that cash helps you fight against some of these things like sequence of returns risk. But you may be saying to yourself, well, I don't trust the market. I don't want to invest my dollars into the market. Another thing you could do is look into real estate. I know Steve and I were talking before the show, and Steve's been a real estate investor for a little while. And so this is another place that you can put your dollars and figure out, okay, well, if I have X amount of dollars here, I can start investing my dollars into real estate, figure out what the cash flow is, and reverse engineer how much I need every single year. These are two of the good starting points to think through this. I prefer, upfront, the easiest or the quickest way to think through this is with the market, only because we have predictable returns from the past, but also real estate is something that you can definitely do, and it is one of the most powerful ways to build wealth long term.
For sure. And that's kind of what I was always taught, was like the entrepreneur's end game was real estate. Like you're going through, you're saving money and putting it into hard assets. I definitely, that was how I was brought up in the startup game, was your exit, was going into real estate for sure.
Exactly. And a lot of business owners love real estate because, again, they can do predictable, repeatable systems and processes to kind of put this into place. And it's very, very much like running a business on easy mode. It's more so like you can run this business and be able to use the same systems and the knowledge and the know-how that you already have to have real estate in place. So that's the two places that I really do think about putting these dollars. There are other things you can do. You can have conversations with your CPA. That's one thing I would recommend you absolutely do, is have a conversation with the CPA. You could even talk to an advisor structure. You could pay them just a fee to have a conversation with you instead of, putting those assets under management, so that you can put together a plan for this step by step as you begin thinking about this. But I would recommend having these conversations and paying these folks as you are in the process of negotiating deals or the exit process, as you start to get a better idea of what this could go for.
Very cool. And before we started recording, we were talking about you exiting a business relatively recently. We'd love to kind of understand a little bit about the mechanics there, and also like valuation wise. I think a conversation that I have pretty frequently is around how to drive valuation up. We talked about profit. We talked about, getting your finances in order, but from the seller perspective, from your experience personally, how have you driven negotiations when it comes to really driving like the value of a business when you're selling it?
Well, the cool thing about one of the businesses, so we had a pickleball business. And so this was a business that is pretty hot right now. It's a hot sport. It's the fastest growing sport in the country still, even as of today. And so we started by buying into one location and expanding out to 5 different locations. And myself and my business partners, we started to expand these locations. It got to a point in time where some of my other businesses were just taking over too much of my time. So I decided to sell it to my business partner, who is still running that business today, and they're doing great. And so the cool thing about this is that when we started those negotiations, I realized pretty quickly I am okay in this specific situation getting to a point in time where this is a fair deal. This wasn't one where I was going to drive the valuation super, super high, because he was already in the business and I was in the business. So this was a unique situation where we both knew exactly what was going on, and we both knew exactly what the numbers were. And so because of this, it was one of those areas where we had to kind of think through and talk about, hey, what does the future of this business look like? What is the potential of this business? Well, whoever stays within this business is going to have a pretty nice payoff long term, as long as they continue to run this going forward, and if they're willing to run it and move forward. And so he wanted to expand a little more. I didn't want to expand. And so we just decided, hey, why don't you just take over, you buy me out, and we'll kind of move forward from there. And so we had to evaluate this in a very different way, since pickleball is kind of a newer sport and it was a newer business. We had to evaluate this in a way of what could the future be. And so we came to an agreement that kind of made sense for both of us, that made it all work out. So uniquely, if you're selling a business to a business partner, it is a little bit harder to kind of get even the higher valuation than you want, because they understand exactly where the business is, and you understand exactly where the business is. And so you got to come to a fair deal that kind of makes sure that you have the everything in place that works. And it worked out for both of us. And I think it's one of those things where it's really cool. We structured it in a way where there's payments that come to us. So we kind of seller finance a portion of it, and then we had the payments up front as well. So it was a really great overall deal, and we share with some of the upside, as time goes on, which is part of what I wanted to do. But in addition, you also get to have some upfront cash as well.
Yeah. Yeah. And I do love the example of selling to a business partner and employees or teams, because it is a reminder that you don't have to have an external PE firm or a company coming in and buying you. You can do alternative types of deals. And I think it's a great example. I've done one before. I know a lot of people that have come to me and asked me questions about exiting, and they don't even think that it's an option, which I think is a good example of you sharing that it happens more frequently than people think. Selling to a team or a business partner is quite common, and a great kind of mutually beneficial thing to have happen. Like you said, you even seller finance some of it, so you're still getting some payments, but they get to kind of take it forward, and mutually win-win scenario.
Exactly. And one thing I love about what you just said was when I'm the one that actually presented this to my business partner and came to him and said, hey, listen, I'm just not passionate about this business anymore, and I would like to figure out a deal. And he goes, I didn't even think of that. I didn't even think that was an option, just like you said. And so sometimes it's just having a conversation and starting to think through, okay, well, how would this work? What are some of the things that we would do? And when we were having this negotiation back and forth, which was more so like a conversation, because that's just kind of how we operated. But when we started to do this negotiation, it kind of morphed from where we started. It kind of morphed into a bunch of different things. And that was just based on how the business was progressing over time. So sometimes if this deal doesn't get done quickly with a business partner, it could take some time. And if the business grows, then you're going to see, it morph into even other steps or other levels. So I think it's a very interesting thing. And if you're ever thinking about it, you can have a conversation, an open conversation with someone. And sometimes it's the easiest move to make, because if you have other people coming in, they're looking at all your financials, they're asking you questions, they could be, PE firms can take 40 hours of your week just alone. So it's one of those things that you definitely want to make sure that if you want the easy route and you feel like as though you're getting a fair valuation, that was really important to me. And so that's why we did it this way.
Yeah. And trust is there. Trust is there.
Exactly.
The hardest thing to balance during the whole external transaction thing. So that takes us to the finale. Knowing what you know now, what would you tell Andrew 10 years ago?
So what I would tell myself 10 years ago is start with a financial position of strength. If you're going to go out into the world, into the business, it's a risk already. And so what I did early on was I put myself in that financial position of strength even when I was working in the corporate world, where I was in this spot where I didn't have to worry about finances on the back end because I started off strong. And so when I started off strong, that helped me tremendously long term. And I didn't realize how important that was until later on down the line, where I had to make very important decisions for my future. And I could make those decisions based on a position of strength. Secondly, I would tell myself to start with operating procedures and SOPs from day one. Going backwards and trying to retrain team members and trying to retrain employees is very hard to do. And it's very hard to get everybody to buy in when you didn't start this way day one. And so that is a very important thing that I think a lot of people need to think about. And number 3 is I would make sure that you choose your partners very wisely, because this is like a marriage. And this is something that in reality is someone you're going to be talking to every single day. Usually it's multiple times a day on the phone. And so you want to make sure that you are choosing these folks wisely. It is one of the most important things that you are going to be doing. And if you don't work well with other people, do not start with business partners, because it is one of those things that is a lot harder than you actually think it is. So those are the 3 things that I would go back and tell myself, because it is one of those things where more and more you do this, the more and more you learn.
Well said. Well said. So that takes us to what you're building now, which is Master Money. What can you tell us about it, and where can people learn more?
Absolutely. So I am building Master Money, which is financial education. And we have a show called The Personal Finance Podcast. So if you like podcasts like this, you can check us out on any podcast player. And we are teaching people how to build wealth. In fact, our goal is to create 1 million millionaires, which is a really fun thing that we're going to be doing. We actually just got a story from a guy who was completely homeless, who then actually became someone who listened to our show, found our show, and through the tips that he learned through our show is someone who now has a house, he's married, he has his first kid. And it's just really cool to kind of see some of this stuff that's happening with a lot of our listeners.
Very cool. And where can they can find it on their podcast? Can they find you on YouTube?
Yes, so you can find it on Apple Podcasts, Spotify, YouTube, any podcast player that you're listening to out there. And if you like newsletters, we have the Master Money newsletter. If you go to mastermoney.co/newsletter, we give you a 5-minute financial tip every single week.
Right on, right on. Well, wherever you guys are listening on iTunes or Spotify, the links that Andrew mentioned will be in the show notes. Thanks so much for coming on and sharing all your business financial advice, as well as your personal finance guru advice. It really, I'm sure it helped a few people out there. Maybe somebody sent a text to a co-founder or a business partner while listening.
Absolutely. Well, thank you so much for having me. I truly, truly appreciate it.